These are the glory days or the golden age of midstream again. With all these projects coming online, there's a lot of pipelines to be built. There's a lot of midstream investment to connect to a lot of data centers.
Welcome to The Next Imperative, a podcast hosted by A&M energy leaders tackling key issues and trends in the industry.
Welcome back to The Next Imperative. This is the second episode in our series on U.S. natural gas strategies. We welcome you to the conversation. Joining me for this conversation are A&M energy thought leaders, Burak Powers, John Corrigan, and Jay Campbell.
When it comes to Jay's great point of, hey, what if we're exporting too much gas and we're drawing this picture of the haves and have-nots, we're starting to run out of gas. What happens then? A really good precedent to look at is Aussie. It's going on right now in Queensland. Queensland, coal bed methane plants, the Aussies call it coal seam gas. They built 3 large projects there, and they really have enough gas to run only 2. And now the population centers in the southeast, Melbourne, Sydney, so on and so forth, the gas price is getting too expensive. Now, the big difference between us and the Aussies, you would say probably to our advantage is we are a lot more forward-looking and understanding of all aspects rather than just reactionary when it comes to consumer reactions. Yep. So I think that is going to play a big difference when it comes to how we make decisions. Good precedent we looked at was, I think it was around 2014 or 2015, we lifted the oil export restrictions. That's when oil actually fed a lot of the liquids cracking, so on and so forth. It was actually to our advantage. But we realized from an overall perspective, it was much better for the U.S. economy. I do think that even the politicians are appreciating how big the LNG story is. I mean, this is a once-in-a-lifetime story. It's like 1940s, FDR, Saudi, ExxonMobil, Chevron, Texaco. Oil. I mean, this is geopolitics. And the politicians realize that having that LNG card is a big advantage when it comes to federal government's influence globally as well. So my personal speculation would be, hopefully we're not going to do the same thing that the Aussies are doing.
Right. Well, and we do have an advantage over the Australians in that our infrastructure is much better connected to our supply. A lot of their LNG is not connected to anything. It's sort of like a behind-the-meter generation, if you will. And I think that's one of their constraints is they did not build infrastructure out to those areas because they didn't think they needed it, and they didn't at the time, quite honestly. So I think that's the dynamic they're living with now is sort of an infrastructure short scenario.
Yeah, I'm going to pick John's hand up here and talk a little bit about data centers. Well, what's interesting is we hear everything about data centers driving electricity demand. And so you would assume that it's also the major driver of gas demand, but LNG is the big story on the gas demand. But let's talk about data centers because it is in the news. Everybody loves to talk about it, and everybody loves to either talk about how great AI is or how much they hate AI and how it's going to destroy the world. So with this nice controversial topic, let's talk about what is happening with AI. It seems that we're in a pivotal shift, and this is my perspective. We're in a pivotal shift in world history where new technology is being introduced, and it's we've seen it before. We see it. We've seen in the past kind of the steam engine, the car, the internet. And every time you've seen a change in how society works, you've seen a lot of new industries being built. You see a lot of old industries dying off. But one of the things that's been constant is the speed of the change has happened much more rapidly every single time. And so now we come to the spot where we're talking about AI. And this revolution is one that I believe is going to impact the world. How? I don't know. We'll see how that plays out. But what we do know is that the largest and most profitable companies that the world has ever seen and governments are in a battle for dominance. And so what that means is you have unlimited cash flow, with the exception of OpenAI, unlimited cash flow coming into this battle. And it's something like, I don't even know how to compare it because I don't know if there's a comparable situation in history where we have this much money flowing into a specific technology because the potential for that technology is great and the implications of losing it, people believe, is far worse. So what's happening there? They are viewing this as not just a competition, but really an existential threat, both companies and governments. It's interesting. I don't know if you guys saw it in the Wall Street Journal. Sam Altman was noted that he wrote a memo to the company saying we're in code red. What happened? OpenAI was the company that everybody said this is the big one. This is the one that's doing it. Gemini, which is Google's product, came out, significant advances in its capabilities, and within a matter of days, people shifted allegiances from OpenAI to Gemini. And that just shows you that these guys are not just making up the idea that this is a threat, but this is a real threat. To win, though, this battle, these guys need power, okay? And to get to the power, they're trying to figure out, how do I do that? Because it's not about the technology. The technology they're pushing as fast as they can, but if they don't have power, they can't power their data centers. And so this is truly a global battle for power. Now, what do we say? What do we do with that? Okay, we need a little bit of power? No, we need a lot of power. These data centers, some of them are the size of, not quite a New York City or Chicago coming online, but medium-sized cities that are coming on with every one of these data centers. And it's specific to a single location. We're talking hundreds of acres. So you're pulling all of the power needed to do a city into the space of a little bit of 400, 500, 6,000 acres, right? Very small spaces. And the question is, the grid was never designed to handle that kind of load. We haven't in the U.S. been doing a great job of keeping the grid up to date. There's a lot of places where the grid is still the same grid from the 1900s, early 1900s even. And there's a whole overhauling that we'll have to do to get to the grid where it is. So we have a problem here, which is we need power. We need it very central locations, very specific locations. We need a lot of it, and we need it now. And there's one other fact. We need it 24/7, 365. Well, we got a problem in that standpoint, which is there's not a solution to do that today outside of natural gas. Natural gas is how companies are basically seeing that as the bridge fuel. In the future, nuclear power may be an option. Geothermal hopefully is an option as well. Some combinations of battery, solar, maybe wind can be part of the solution as well. But to get 24/7, 365 power to drive these things, these data centers, it's natural gas. And so that's really the story on that, and that's what's driving it. Is it a 20-year, 30-year pull on natural gas? Maybe. But I think the plan right now is the developers, specifically the tech companies, do want to be environmentally friendly. They do want to get away from emissions. They're just not willing to lose the race over AI for it.
Right, and nor should they. But this is going to have a huge impact on demand. Brock, to your point, 15 years of proved reserves at kind of current demand. So this is going to pull some of that forward, in all likelihood.
It absolutely pull it forward. And if you notice, a year and a half ago, we were talking about big data centers being 100 megawatt data centers. Now they're like gigawatt data centers. What are we next? Well, actually, the interesting thing, I don't know if you guys saw Musk and Huang Jensen from NVIDIA are talking now about data centers in space as something possibly in the next 5 years. So you're like, whoa, what are we doing? This is the extent to which they view this as a key issue. They need power. And by the way, the space thing, I know this is a little aside, the space thing is not that crazy.
It solves the cooling problem.
It solves your cooling problem,
yeah.
which is 80%, I think, of your power demand.
Yeah.
And you can follow the sun, so you can get around 24/7, 365 sun coverage. We'll see how that works out. But but the idea is that if that's what they're saying, is we will do anything, including go to space to get this. What are they going to do to make sure that they have the power that they need today to win this race? And right now, the solution for them is natural gas. And the problem they have now, so it's power generation through natural gas. But the people that are probably the least popular right now is like the companies that are building the turbines for natural gas power gen. There's a multi-year backlog on that one.
Yeah, and that's going to be, I think the great, well, I see it as a great thing. I'm sure the industry, the AI industry sees it as a terrible thing, is the pacing that the generation manufacturing is going to require is going to allow the industry to catch up and supply that, and not just drilling, but also the midstream, right? As we all learned over the last 15 years, you can't build a pipeline overnight. Even with a friendly political environment, you still have to go through the process, and the process isn't an overnight process. So I think that pacing is going to allow us to, the industry as a whole, to meet those demands as they're ready to start flowing that gas.
Yeah. I think what's interesting in this whole situation too is that data center developers are doing something they probably never would have thought that they were going to do, and tech companies as well. They're getting into power generation world. And what I mean by that is they're starting to say, look, we do have a grid issue. And by the way, a lot of consumers don't want me plugged into the grid because it's just going to drive up their electricity price. So, well, I guess we can co-locate generation next to our data center using natural gas, which is a very logical thing. But now all of a sudden, I've got to figure out how do I manage and run a power plant, natural gas powered gas plant or power plant, along with my data center. How do I do that? Well, now partnerships. You've got utilities partnering with tech companies, and then they're saying, well, we need the gas. Where do we get the gas from? We need a massive source of gas. We need a continual source of gas. Well, let's start looking at fields where we can pull that from. And so that's why the Permian is heating up right now as well, is all that associated gas. It's getting funneled into data centers, or at least the plans are. You're seeing announcements around we're going to start taking the gas from the Permian and the associated gas from it and shooting it towards data centers and power gen. And so it's a great solution for the operators, E&P operators, in the sense that before they were dealing with bottlenecks and they're having to pay a bunch of discounts on their gas prices coming out of the Permian. We saw even this past month or so ago, we saw negative Waha prices that were just killing margins. So if I got an outlet for gas that's secure and set for 5, 10, even 5 years, I'm going to take that bet if I can.
Well, I certainly like your clients that are co-locating their generation. I'm a midstream guy at heart, so and this probably actually applies more broadly because it does apply to LNG as well, because you've got these big investments, and when they're not running, they're not earning, and you got to solve that problem. The level of security, supply security you need, whether it's the turbine, whether it's the generation, the regulation, which is the batteries and other things, as well as the gas supply, you can't just put one power plant. If you need 1,000 megawatts, you can't put 10 100 megawatts units on there and say you got it covered, because they have to go down for maintenance. They have to go down, they go offline for mechanical issues. So you need redundancy. And you need redundancy in your gas supply as well, because if pipelines go into maintenance, pipelines go into, people dig into fiber cables, they dig into gas pipelines, and you can't afford to have a data center go down. So they're going to need a pipeline coming in from one direction, from a different field or different source than the pipeline coming from the other direction, but they both have to come into the same plant. And that redundancy and that sort of secure portfolio is the same as LNG, right? So when we first started building LNG plants 15 years ago, there was one pipeline they would connect to. Then they discovered, oh, well, that doesn't work. I need a second route, and then I need storage, and then I need, and as people start, all of a sudden now you're getting people paying a premium for assets in reserve and redundant assets. And as a midstream guy, that's just music to my ears because I love to build assets as a midstream person. So I think that's a positive for the industry. It's positive for the upstream players. So I think, like I said, it's going to be a nice time. So
Yeah, I think on the midstream side, you're exactly right. As the E&P operators probably have the most to gain, but they're limited by their midstream takeaway capacity. They're limited by their dedicated areas for midstream providers. They're limited by the length. They've already locked into some pretty long-term contracts, or could have locked into some longer-term contracts. And you don't want to tie to a single well or even a field. So to your point, you have to aggregate all the gas, and you've got to aggregate it so that you're not even running it through a single gas plant, because gas plants, as we know, especially in the Permian, can go down. And so really thinking through that redundancy is part of it. And what that's going to take is it's going to take E&P operators coming together with midstream operators, coming together with developers and maybe even utilities or whoever's going to run the power gen, and thinking differently about how do we partner? How do we actually, there's a lot of money here on the table. Maybe the money isn't all in the areas we want the money to be, but there's got to be a way that everybody here can benefit from this.
correct. Yeah.
And the power is so critical to data centers. Meta announced just a few days ago they're planning to stand up a power trading business. When you first think about it, wait a second, owner of Facebook is going to buy and sell power? Yeah, makes perfect sense. From a cost control perspective, it makes sense, but also from an intel gathering perspective. Their future depends on power. They really want to understand the supply-demand fundamentals of power. To be able to be a good trader, you got to understand the fundamentals. They're saying, this is my lifeblood, my lifeline. I really want to understand this business.
Well, and when you look at, as they build these data centers, they're building this redundancy into their designs, right? So I can leave, if I have, let's say, 1,000 megawatts and I build 1.6, well, on any given day, I'm running about 1,000 megawatts. I got 600 megawatts available to sell. If I don't sell it, those assets are not making any money, and that's a lot of assets sitting there without making money. So I think you'll see all these people that co-locate, and whether they do it as a partnership or as they stand up their own commercial capabilities, I'm surprised they're not gas trading as well. They probably are adding that and just not making that announcement. But I think those commercial capabilities are going to come into play across, whether it's at the producer level, at the data center level, or even the midstream level, right? So if you want to be able to serve these different markets, selling it at the first liquid point is not going to make anybody happy with you. If you want to partner, you need to be able to do long-term structured contracts that allow for redundancy, that allow for very tight reliability and variability, optionality built into your contracts. All of these things are going to lead people down the path towards a more sophisticated commercial capability, whether you're upstream, midstream, or a demand level, because it's required. Otherwise, you're going to have a bunch of assets just sitting in the ground, not doing anything.
Let's start pulling this conversation together. What do we think consolidation trends are going to look like given the supply-demand dynamics we just spoke about?
Geoff, we, as an indicator of consolidation, we looked at what is called a Herfindahl-Hirschman Index, HHI. Very quick note on the HHI. HHI is just the sum of the squares of the production market shares for each company. Give an example. If you're looking at a monopoly with 100% market share, square that, you're reaching the maximum HHI of 10,000. The higher the HHI, the more consolidated. Looked at the HHI for the key gas basins going back to 2010. Some interesting trends emerged. Let's start with Marcellus. Marcellus is the most fragmented, and even though it is the most fragmented, it's been relatively quiet for the past few years with a few exceptions. Some of the large players made some acquisitions, but overall, M&A has been fairly quiet. Now, interesting thing about Marcellus, as we talked about, is the acreage quality is going to decline the most and the soonest among the key gas basins, which means in Marcellus, we're going to see a really big have and have-not picture emerging. Put those two together, we think there's going to be some M&A activity in Marcellus. If you look at Utica is actually the most consolidated. And there's been some recent roll-ups by large producers consolidating, contributing to that. But overall, for a while, it's been the most consolidated now. It has favorable IRRs and break-evens, which makes sense, liquids-rich content of the gas. There's some potential consolidation, but we think the biggest promise here, along with Marcellus, is vertical integration. You're going to share a lot of your infrastructure with Marcellus, and you have nearby big data center existing and coming up. Last one we looked at is Haynesville. Haynesville is quite interesting. LNG, as we talked about, is a really big story. And in Haynesville, we have seen some more fragmentation recently, and we've actually seen that in mid to late 2010s as well, when the first wave of LNG was coming on. Because of that big promise of LNG, new players are coming on, or people with acreage are producing more. One interesting story we have seen is some of the large Asian LNG buyers have actually started buying up acreage in Haynesville. Strategy makes perfect sense. If you're operating it, you can actually use it to really understand as an intel gathering tool to understand where the gas markets in the US is heading. Hey, supply demand people you drew. From their perspective, firsthand, does that actually make sense? Do I agree with it? If you're getting into it as a non-op, it also makes sense because it is a financial structural hedge on your LNG cost versus the gas profits. So we could see more LNG large buyers coming in and buying up acreage. Similar to what we have seen in also late 2010s, after the more fragmentation, there was actually a wave of consolidation coming on as well. Why? You do need the scale to be able to serve consistently those LNG projects.
I think when I look at the LNG buyers, I think, you see a lot of people coming in to get that financial hedge. You can't sign a 20-year contract and go to the ICE exchange. Well, there's just no liquidity in the market for a BCF a day for 20 years, right?
Right.
You get past 6 months and all of a sudden the liquidity starts drying up fairly quick. So there's only one way to do it. That's to own the reserves in the ground. And to your point, you could either be a producer or a non-operated operator and just have the equity in the gas and let it ride. So I think we're seeing a lot of that. And I think the other driver is going to be, again, going back to that notion of, am I big enough to serve this market? And that's going to be a big thing for LNG and for data centers is, can I solve the market's problem by myself or significantly by myself so that they don't have to have 30 contracts, they can do 5 or less. And I think that's going to be something that drives consolidation for people who are more commercially sophisticated because it's really hard to get 20-year contract from anybody is hard to find. So the only way to do it is through equity.
Let's bring the whole conversation together. What are the key strategic implications of what we've been talking about, the supply-demand issues? I imagine it's going to vary by industry vertical. John, would you maybe start us off, talk about midstream and LNG?
Sure, yeah. I think, these are the glory days or the golden age of midstream again. We kind of had a lull there. But I think with all these projects coming online, there's a lot of pipelines to be built. There's a lot of midstream investment to connect to a lot of data centers. The good news about LNG is they're very big and they need to aggregate gas from multiple areas. So you're seeing a lot of pipelines being built dedicated to these LNG facilities. And there are a lot of expansions to bring more gas into the coastal areas for the LNG facilities. The more interesting one is going to be the data centers, where there's going to be a lot of mid-sized pipelines trying to connect the basins to these data centers, whether they're in Ohio or Minnesota or West Texas, wherever they are. There's going to have to be some pipelines built to those. So I think that's an opportunity. We didn't spend a lot of time on it, but storage is another one. There is, we're not exactly to the point where we're talking about putting natural gas storage in space like data centers, but
Long pipeline.
there's a bit of a space race right now to get enough storage capacity to handle the kind of swings. Earlier it's kind of fascinating that one of the LNG facilities went down this fall, and it dropped LNG consumption of natural gas by 1.3 BCF. Again, it's like losing, a city just shut off the lights for 6 months. And, you didn't see a collapse in you saw some price impact for sure, but not, where do you put that much gas in 24 hours? You don't have a lot of time to respond when it's an outage. So more and more people are like, I need more and more of this stuff to create that buffer. And I think, especially for salt storage, people are scrambling, looking for things, and, maybe reconfiguring some of the reservoir storage to handle massive injection quantities. So I think there's going to be a nice investment case for storage. And then the last bit is the commercial. I think the midstream companies are positioned well to create that redundancy in both the infrastructure as well as making the commercial contracts work that work for either an LNG off-taker who needs that steady supply at low cost, or a data center provider who needs that redundancy and that sort of on-demand response. So I think that's where all the fun is going to be in the midstream and LNG right now. In terms of new projects for LNG, I think there's enough proposed, certainly enough in FID for the next 5 years. But there's still a backlog that's working its way through FERC. So those opportunities are there. It's, I don't know who's going to own them at the end of the day. There's a lot of people out there shepherding their projects through right now.
Jay, what about from the data center and investor perspective?
Yeah, for the data center, I think we've covered it pretty well, but just to highlight the important facts here is that we are in the middle of a worldwide competition with the most well-funded companies and governments in the world racing to win this battle. And it is a battle that is primarily, which is interesting, it's not a tech battle, it's a power battle. And by extension, it is a natural gas battle. And so I think that's an interesting factor. And for the next 5 years, maybe 10 years, that is going to be the case. Beyond that, when we see nukes, geothermal, and other things be more realistic than on scale, then great. You maybe see nat gas start to fall off as the primary source there, but that's it. And so the other interesting thing is that power procurement. You talked about this with Facebook, Meta. Power procurement is a competition as well, and it is a key capability of these operators. And so that's going to be interesting to see how those play out. But the bigger thing that I think about with data centers, it gives an opportunity to think differently across the entire value chain and partner in ways that have historically not been there. And so I think it's a really exciting time for E&P operators, for midstream operators, for power companies, for utilities, for data centers to all come together and start, how do we figure this problem out? How do we figure it out quickly? And everybody wins. And the faster we can figure it out, the more everybody's going to win. So I think that's a really interesting one. For the investors and the boards, I think we're going to continue to see continue on with capital discipline. You have to do that, same as always. For the E&Ps with significant gas or associated gas, Permian comes to mind specifically, they really should be challenging their management teams. How do we take advantage of this? How do we take advantage of the fact that there is a massive play for gas here? And what can we do? Who can we partner with? What JVs should we enter into? In order to, maybe who should we acquire to be able to take advantage of this and not just sit on the sidelines, because at least in the near term, this is where the money is and this is where the value is. And the other thing is just keeping optionality. Things change very, very quickly, especially with tech companies. And so being able to maintain that optionality and say, how do I keep the different opportunities open for me on how I'm using and directing my gas flows is going to be an important question to think through there.
Burak, what's the upstream implications for upstream?
Upstream, Jeff, there are really three key strategic implications. The first one is, as we alluded to before, protect your tier one runway. Yeah, we are already seeing some of the large companies with strong balance sheets doing this. They have done this analysis. They know that good times for them are around the corner if you do have good acreage, and they're choosing not to develop all that acreage right now. Now, if I'm a high-cost producer, sometimes I might not have that option. Maybe I don't have a strong balance sheet, or I don't have the alternatives in my portfolio. But you still have the option to improve your cost structure. So in the short term, you can actually survive better, so that when the tougher times are around the corner, you're not as desperate. So protect your tier one runway as much as you can and get ready for it. Second one, as John alluded to, is really build durable egress and commercial agility. It really comes down to, do I have a good commercial use for my gas? Can I sell and serve the demand pockets out there? Did I identify the locations? And did I get into the right partnerships outside my comfort zone? And number two, if you can, co-locate with storage or build storage to monetize price volatility. Last one is optimize your portfolio. This is really the big story, haves and have-nots. How uneven things are going to get is going to present a lot of opportunities and a lot of challenges. So get ready for a lot of acreage swaps, get ready for a lot of tuck-ins, and get ready for rationalization of a lot of the fringe portfolio out there. The most important thing I would say is, at this point, while you still have time, revisit and execute a basin-specific M&A thesis. People are complacent right now. This is not the time to be complacent. So one thought I would leave folks with is, while you still have the time, dig your well before you're thirsty.
Gentlemen, thank you. It was a great conversation. Learned a lot, and clearly a lot of work's been done getting our heads around this, and a lot of things to come. To our audience, we hope you enjoyed this conversation. We welcome you to join us again on future episodes of The Next Imperative.
Thank you for listening. Make sure to subscribe to The Next Imperative so you never miss a new episode. Also, visit our website at alvarezandmarsal.com to learn more and to connect with us.